Hi, I'm David Armstrong. I'm managing editor of wealthmanagement.com. I'm here with Stephen Walsh. He's the chief investment officer of Western Asset Management, about $450 billion under management, fixed income shop. Steve, thanks for taking the time.
Happy to be here. Thank you, David.
Investors looking for fixed income, looking for places to park their money, looking for safety. Where should they be looking? Europe is not the place to be.
Yeah, I mean, Europe's a key issue for investors today. You can't have an investment opinion today without thinking about Europe. It's a pretty significant thing hanging over the market issue, and we don't think it's a knowable outcome. It's extraordinarily complex, and the outcome is going to be determined by politics. So as a result of, we kind of think of an inability to know how that plays out, we've been staying away from Europe. But we don't think that precludes some really good investment opportunities within fixed income.
Mm-hmm. Where should people be looking for?
The credit-related sectors. If you think about, a lot of people have the perspective of, well, what can I do in fixed income? And they think there's nothing left because treasury rates are so low. But if you look at the credit-related sectors, an example would be the U.S. high yield market. Mm-hmm. The index, the U.S. high yield index, yields about 8% today. We think that represents really good, solid value for a group of companies that have really strong balance sheets today, very low default rates, makes it a pretty attractive investment, around 8%. So even with the uncertainty of Europe, we think high yield, for example, would be a good place for investors.
So you think going a little bit down the credit curve a little bit?
Well, the index, as I said, as you point out, yields 8%. You could either buy at the high end of the quality spectrum, which would be double Bs at about 6.25. You could go down to triple Cs about 11.5.
Yeah.
We wouldn't put all your money in the triple Cs. We do find value across the spectrum, but actually at this stage we have been easing down the credit spectrum a little bit, finding those 11.5% yields pretty attractive for, again, we think some good companies.
Interesting. What about emerging markets, sovereign debt in emerging markets? Right. Is that a viable place to play?
Yeah, if you think about emerging market, there's really three sectors. There's hard currency or dollar denominated sovereigns or corporates, and then the local currency debt. Of those three, our favorite would be the local currency debt. A lot more volatile. You need to consider that when you're constructing a portfolio because, for example, last month the Mexican peso was down 10%. That's a lot of a move for a bond. But we do think the local currency bonds represent the best value. We do like Mexico, we'd like Malaysia and Indonesia within Asia. And then within the dollar denominated debt, we like corporate debt. Corporate debt, again, looks very, very attractive versus sovereign.
In the emerging markets, corporate debt?
In emerging market corporate debt, yes.
Mm-hmm.
Yeah.
Where would you stay away from? U.S. Treasuries, Europe, anywhere else that you cautious about going into?
Yeah, I think it is taking a lot of interest rate risk or not. I wouldn't have a portfolio that had zero in U.S. Treasuries today. Treasuries represent an insurance policy to hold on to in case the world gets to be a really difficult and challenging environment. But our argument has been lately that it's a pretty expensive insurance policy. So own some, but own a very small percentage of it. So staying away from interest rate risk would be the number one issue that I would mention to retail investors when they're constructing portfolios. Longer term, buying a 1.5% treasury note out in 10 years, I don't think will be a good investment. Mm-hmm. That would be the primary sector. Secondly would be European banks. I think there's a lot of question about how European banks and the sovereigns are attached at the hip. They're very closely associated, and how that situation unfolds would have me want to stay away from the European banking industry.
Mm-hmm. And you'd stay away from European sovereign debt as well?
Yeah. Think about this today. So we could invest in Spain at about a 6.80 yield today. Does that represent good value? I think I'd take a basket of U.S. high yield companies at 8% versus a Spanish government that I really have a hard time fully understanding what's going on there and the political nature of the issue. I think I'll take my chances with a group of companies that I can do some good, sound, bottom-up analysis and construct a portfolio of around 8% versus going out and taking a roll of the dice on Spain at 6.80. Now, if Spain turns out to be okay, that's going to be a good investment. But if Spain's a good investment, so will my high-yield bonds because the whole world will feel a lot better.
It's the correlation between all these things.
Yeah.
And what about any corporate debt in Europe? Obviously not the banking sector. Any other corporate debt in Europe that might be?
Well, it depends on how close you want to get to the fire. Telecom industry, some of the utilities, they're going to always need telecom companies in Europe, and they're going to need utilities. So again, a lot of risk there. We dabble our toe into some of those names, stuff like, again, the more safe and secure sectors within Italy, telecom and the utility sector, some basic services that we think will always be there. They're very cheap today. I wouldn't pile in with all my money, but that'd be a sector that you might put your toe in the water a little bit.
Sure. You make any calls on Europe? What's going to happen there?
Well, we're famous for saying the outcome in Europe is unknowable. Now, that doesn't sound very satisfying. You get the CIO on, they won't give me an answer. But the truth of the matter is, as I said, it's such a complicated issue, and outcomes that are going to be determined by politics